There's one stock strategy most beginners overlook that can unlock serious, steady gains. And after years of trial and error, I found a proven method of selling stock options that's easy to follow and safe, even if you're brand new. So in this video, I'm going to show you exactly how you can use my four-letter framework to master selling options in 2025. And if you want to make your first $1,000 trading options even faster, make sure you subscribe to my channel. Let's make things simple. Most people hear options and picture confusing charts and risky bets. But what if I told you there's a four-step hack that makes it easy to remember? Enter the C.A.S.H framework. Imagine you're running a ticket booth at a concert. Here's how it works. C is for collect premium. When you sell an option, you're the ticket seller. You get paid the cash up front. In trading, this cash is called premium. No matter what happens, the money is yours as soon as you make the deal. A is for accepting an obligation. So here's the catch. By selling the ticket or option contract, you promise to do something if the buyer asks. If you sold a put option, you might have to buy 100 shares of stock. If you sold a call, you might have to sell 100 shares. It's kind of like promising to save a front row seat for someone. If they want to use it, they can, and you have to honor the deal. The S is for setting the terms. You get to decide the rules as the seller. When does the ticket expire? That's the expiration date of the contract. How much is the seat worth? That's the strike price. We want the contract to last a week or a month. You get to choose. The longer the contract, the more you're going to get paid. But the sweet spot that I've found is to stick to 30 to 45 days to keep things simple as a beginner and take advantage of time decay so the value of the contract drops quicker as the expiration date gets closer. H is for high probability. You want the odds on your side. In ticket terms, you only sell seats you think no one will actually use. Out of the way, less likely to be claimed. In options, though, that means picking strike prices that are less likely to be hit. There's a handy number called the delta that tells you your chances. If the delta is zero point 0.2, there's a 20% chance you'll have to buy or sell shares, meaning there's an 80% chance you just keep the premium and nothing else happens. So how do you use this information? Well, next time you're looking at selling an option, remember, collect your premium, know what obligation you're accepting, set the terms to fit your comfort, and pick high probability trades. Start with stocks you wouldn't mind owning, or if you have shares in your account already, and use the delta to stack the odds in your favor. But here's the thing, even if you've mastered the C.A.S.H framework, there's still one giant hurdle. How do you pick stocks that actually go up in value? Because let's face it, this strategy isn't much help if your stocks take a nosedive. So, how do you find those companies that are more likely to go up? Here's what you can do. Have you ever used Google Maps to try and find the best route to a new coffee shop? You don't just guess what street to take, you use shortcuts and info to avoid traffic and get there faster. Options trading is the same thing. Instead of guessing which stocks to pick, you can use a few simple shortcuts on a stock chart to stack the odds of picking good companies highly in your favor. Here's your step-by-step GPS for finding strong stocks. Step number one, follow the trend. First, you want to check that the stock price shown on the chart is currently trading above the 50-day moving average, which is shown right here with this yellow line. You want the stock price to be above that right there like it is. This 50-day moving average is just the average price of the stock over the past 50 days. If today's price is above that line, it usually means the stock is headed in the right direction and moving up higher. Step two, double check the strength. Next, you want to see that this 50-day moving average, this yellow line, is currently above the 200-day moving average, which is this red line right here. You can see on the chart that the yellow is above the red, which is exactly what you want to see. And the 200-day moving average, this red line right there, it's like a long-term health check for the stock. If the shorter time frame 50-day is above the 200-day, it's a good sign the stock has been strong for a while, which you can see here zooming out that Google has been on a bit of a tear lately, starting from back in April of 2025, moving higher. Step three, look for volume spikes. At the bottom of stock charts or most charts, you're going to see these spikes showing the daily volume for the stock. This is just the amount of shares being bought or sold each day. Big spikes like right here and right here can mean a lot of people are interested in the stock, which can help push the price higher or beat it down lower. You're going to want to take note of these sections right here because they will identify areas that are likely to hit for support and resistance. Step number four, find support and resistance. So speaking of support, It's kind of like the floor in your house. It's a price level where the stock tends to stop falling and bounces back up. And if we have these outliers right here, confirming some areas of support, it may be at this price point right here around 150 or up here closer to 175. Those could be potential areas where the stock may bounce off of. And resistance, well, it's kind of like the ceiling of your home. It's where the stock often stops going higher. And there's an area right here. We've got an outlier candlestick right there, which is kind of the biggest one in that little grouping, which corresponds to a potential ceiling up here at the 208, 209 price level. So if you see this stock price pulling back down to the support level, it could be a good time to sell a put option, thinking it's going to bounce back up off of there. And if it's hitting resistance, like it may be kind of getting there right now for Google, it may be ready to turn back, and it may be a good time to sell a covered call with the stock likely to drop or bounce back lower off of that ceiling. By following these type of shortcuts, you're not just guessing, you're using a proven process to find stocks with momentum and strength. It's kind of like following turn-by-turn directions instead of driving with the blinders on. Next, I'll show you how to take this one step further and use your chart to spot breakout patterns so you can boost your odds of winning your options trades even further. So you know when you played Super Mario as a kid and you sucked at one of the harder levels. Each time you tried, though, you would get a bit further into the level before you died, and when you finally beat it, you had played it so many times that you knew exactly what you needed to do to get to the finish line and win. That's exactly the kind of repeatable system you want as an options trader. The best traders use chart patterns they've seen work over and over. When one pops up, they know exactly what to do with it. It's almost like trading on autopilot at that moment. The first pattern I want to show you is the ABCD pattern. Imagine a stock that's been moving sideways, kind of like Meta was back in October of 2024, and then suddenly it jumps up and it goes from point A to point B. Now that move is pretty hard to spot, but after that, it cools off and drifts down a bit, moving down from B to C. And as long as it doesn't drop all the way back down to part A down here at 550, we've got a potential ABCD pattern in play where part D, the stock is going to go and just start moving higher again and go that C to D pattern and just start taking off. If you can spot that B to C drop where it lands at a higher price than where A was at, and you can load up, you could sell a put there and potentially make a lot of cash really quick when the stock does explode higher in this C to D phase. And I've seen this one play out so many times. It's really simple to find. I just like to check my charts for it every Friday afternoon and Monday morning before placing my trades for the week in case I can go and catch one. Another pattern is the bullish flag pattern. This is when a stock shoots up a flagpole very quickly, just like Amazon has back in December of 2024, creating a nice solid flagpole for us. Then it drifts down the price of the stock a little bit further, creating this kind of flag between two lines. If we put that line there and this line here, we've got this kind of triangle which looks and acts like our flag banner. We'll just move it out a bit further in time so that they touch or just about touch. And there's our flag pattern. But what happens here is eventually the stock is going to break out and move higher or lower. If it is a break to the upside of this flag, of this top blue line, we can sell a put. If it's one to the downside, you could potentially sell a covered call. This example happened to break to the upside right there and then moved higher. So it would have been a great time to get in and sell a put option when this candlestick right here developed. Now, it's easy to talk about strategies and patterns, but the real magic happens when you put them to work. And after 6 years of learning what to do, and maybe more importantly, what not to do, here's how I actually trade and sell options today. Let's jump into a real trade so you can see every step in action. So here's a condensed version of 6 years of training to figure this out and looking at a stock called AMD Advanced Micro Devices. Number one, we want to check that the stock price up here is above the 50-day moving average, which we can see with the yellow line is right there. So the stock price is above. That's a good thing. Next, we want to make sure that this 50-day moving average is above the 200-day moving average down here, which it is. That's a good thing. Then I want to check for some recent candlestick spikes. I can see one right here, which corresponds to this price point right here around 163, which may be a good price point for my strike price when I'm selecting my put, but we'll leave that for a second. Then I just want to scroll back out in time a little bit, see where the recent all-time high was, because I don't want to sell a put option potentially if the stock is approaching the all-time high. I can see that it's back here in March of 2024, and it tapped 226 up there. So there's still a good chunk of real estate for the stock to go through all the way to get up there. So there's room for it to run higher. As you can see with this zoomed out version too, we've had a nice run up ever since April with the stock kind of just slowly chopping higher, which is a pretty good sight to see on the stock chart. So I'm okay with this. And we're going to look at an options chain in a second, right around that 163, 165 area right here for potentially selling a put option, meaning I'd have to buy shares of AMD if the price dropped from 181, where it's currently at, all the way down and below this 160-ish, 165 price point right there. Now, inside Interactive Brokers, where I do all my trading, I'm going to click on AMD inside my watch list. I'm going to open up the options chain where I'm going to go to trade my options right here. And you can see I've got my calls on the left side, my puts on the right side. I've got the strike price down the middle and my expiration dates over here in the top left-hand corner. I'm going to go out to about 30 to 35 days away and just start with September 19th to see how far that is. That's 36 days away, which is great for this trade. That's fine. And I know that I've got a 160-ish, 165 strike price in mind based on the technical analysis on the chart. So I'm going to look on the put side right here to sell a 160 or a 165 put. What I'm going to choose between the two of them, I'm going to go ahead and sell the 165. And the biggest thing I'm going to ask myself right now is if I'm okay owning shares of AMD at 165 if the stock happens to drop all the way down from 181 right now, which I am. So in this case, I sell the 165 put. I would get paid $335 because every option contract contains 100 shares. So you take this 335 and you times it by 100, 335 bucks going in the pocket. So I would click that. I would have an order up here. I would be selling this option. My price at 335, or I can even do the midpoint at 340, make a couple more bucks. Click submit, and that order is in the hopper now. Once it actually goes into my account, then I can go and look and manage it as time goes by. And if we hop into my portfolio area over here, we can see that the stock option contract did get filled in there. AMD September 19th, 165 put. It ended up filling at the 334 price. So I stand to make $334 in 35 or 36 days. So now if you're following along, you've got a live trade in the account. It's exciting, but maybe a little bit nerve-wracking as well. The big question here is what happens next? So let's walk through what you'd expect after you hit the confirm trade button. If it's your first time making a trade, it might feel similar to the first time you asked someone out on a date and they actually said yes. First you're pumped, then you think, oh crap, now I actually have to plan this thing out, but don't worry, I'll be here to help you plan your next steps. Here's what happens after you sell a put option. If the stock price stays the same or goes up, you can just wait. The option contract will lose value over time and you will keep most of the profit. I usually close trades when I've made about 80% of the potential profit in the trade. If the stock price goes below your strike price, you might have to buy 100 shares at that strike price when the contract ends. Sometimes the price bounces back up before then, but it's always smart to have enough cash in your account ready just in case you do have to buy. When selling covered calls, it's the opposite. If the stock price stays the same or drops, you'll be able to close your position off for a win after some time goes by. But if the stock price goes above your strike price, now you may have to sell 100 shares at that strike price, depending on where the price of the stock ends up on the expiration date. The great thing for beginners, you don't really have to do too much. Just wait and let the contract play out. Either it expires, nothing happens, or you're assigned shares or have to sell them. Both are normal parts of option trading when you're the seller. And if you're worried about being assigned shares or losing them, stick around because next I'll explain why it's not as scary as it sounds. When you sell an option contract, you're setting yourself up for two possible outcomes. Most of the time, if you follow the steps that I shared earlier, the odds are in your favor and it's very unlikely that you'll have to buy or sell any shares. But there's always that 20 to 25% chance that things don't go as planned. And you know what? That's completely normal and it's not as scary as it sounds. Let me break it down for you. If you sell a put and get assigned shares, getting assigned just means you have to buy 100 shares of the stock at the price you picked, aka the strike price. Think of it like getting a great deal at a store. You're buying those shares at a discount compared to where they were trading at before. This is actually a good thing, especially if you already decided you'd be happy owning the stock at that price. It's all about being prepared and making smart choices before you enter the trade. If you sell a covered call and your shares get called away, Having your shares called away means you have to sell your 100 shares at the determined strike price. Some people worry about this, but here's the upside. If it happens, you get your money back so you can make more trades. You've likely sold your shares for more than you paid for them, so you lock in some profit called a capital gain. Plus, you collected option premium when you sold the call option, adding extra cash to your account. So, the big question you need to ask yourself before you make any trade, just simply ask, would I be happy owning this stock at the price that I'm picking? If the answer is yes, then assignment really isn't a problem. It's just part of the plan. And if your shares do get called away, celebrate the win and get ready for your next trading opportunity. So there's no need to stress about the trades that don't go your way. Sometimes what feels like a loss is actually just another way to build your portfolio and collect more profits over time if you're patient enough. Next, let's look at some rookie mistakes new traders make so you can avoid them and set yourself up for success from the start. I will never forget the time I sold a put option on the stock Pinterest right before an earnings date. I was chasing a juicy premium thinking, worst case, we'll just own the stock, but when the company missed its estimate, the stock dropped like a rock. And I got assigned 100 shares that I hadn't truly researched and didn't particularly want. It kind of felt like buying a car that was on sale without checking if it even had an engine in it. The lesson? Premiums can be high for a reason. Earnings can flip your trade upside down overnight. Another mistake I've made, and I see new traders make all the time, is selling super short dated options like 1 to 2 days without any real exit plan. You're collecting fast premium for sure, but if the stock moves against you quickly, you've left yourself no time to adjust or manage the trade. It's kind of like jumping onto a moving train with no idea when you're going to get off. It's exciting up to the point when you realize you're kind of stuck. And then there's the assignment risk. I've seen traders get caught off guard, suddenly owning shares that they weren't prepared for, or worse, being forced to sell shares that they didn't realize they needed to hold on to. If you don't understand what can happen at expiration, especially on the last day of the contract or in after hours trading, you're flying blind. Plus, many forget to consider the capital requirements. Selling a cash secured put might seem simple, but do you actually have the cash in your account ready to go in case you do get assigned? Do you know how much you already have tied up in other trades and how much room you've got left? These are the kind of blind spots that turn small mistakes into big problems for new traders. Bottom line, selling options is powerful, but it's not set it and forget it. You need to have a plan, you need to fully understand the risks, and have enough capital to handle the worst case scenario. Learn from my face plans and try not to repeat them. And hopefully by now you know how to sell stock options with confidence, but let's take it a step further. How can you use these skills to safely bank your first $1,000 of option income? That's exactly what I'll show you in this next video. Click there and watch it now.